In this video, I would like to highlight how you could use technical analysis to evaluate the price of a given security. This particular approach of stock involves studying historical price movements and trading volumes to identify precisely the stock price in the near future, which is called forecasting. So here are key components and concepts in technical analysis. As a stock investor, you're either a technical analyst or you are a fundamental analyst. You may be a trader anywhere, but these are the two most important strategies involved in stock picking. I want to highlight this aspect of technical analysis. Number one is price charts. Analyze price movements over different time frames using charts like the bar charts, the candlestick, the Japanese candlestick models, and other relevant charts to be able to identify precisely the nature of stocks to pick, the right price to enter, and as well as the ideal price to exit your position, considering your time horizon as well as your future investment goal in mind. Number two is on trend lines. These are drawn on charts to justify and to identify the direction of price movements. It could be uptrend, it might be downtrend, and it could be a sideways movement. All the same, that will give you a guide as regards to what you want to buy, how to buy, when to buy, and even when to sell. It's necessary you understand the application of price trends when it comes to the analysis as well as the purchasing and sale of any given securities. Number three is support and resistance level. Identify price levels where stocks tends to stop falling. That's called the support, or rising, which is known as the resistance, often used to predict price reversal. Usually when the stock is rising, you get to a point where it no longer rise again. That's the resistance level. And if it is falling, you get to a bottom, it cannot fall below that. That is the support level. So these two bands, these two limits are necessary you understand as a trader and of course as an investor. Number four, moving averages. Smooth out price data over a period of, let's say, 50 days and 200 days to identify trends and potential support or resistance level. So it's important, an idea of what moving average is all about. You can't do without the knowledge of the application of moving average as a technical analyst. Number six is volume analysis. Examine trending volumes to confirm trends and spot potential reversals. So increased volume often supports the strength of a price movement. Usually when there's an increase in volume, naturally the price itself will tend to go up. And when there's a reversal in that particular trend, a decrease in volume, that will portend a reduction in the price level of a given stock. Number six, technical indicators. Use mathematical calculation based on price and volume data to identify trends, momentum, volatility, and market strengths. And of course, common indicators include number one, relative strength index, number two, moving average, convergence, divergence, and as well as number three, Bollinger Bands. Bollinger Bands measure volatility and provides potential buy or sell signals based on price movement within bands. And then, not only that, we consider moving average, convergence, divergence. It shows the relationship between two moving averages to identify trend changes. And then lastly, number three, relative index trends. It measures the speed and change of price movements to identify overbought or oversold conditions. This is a bit complicated. That's why I don't actually buy into technical analysis. It is somewhat technically challenging compared to your normal fundamental investing. Number seven, chart patterns. Look for specific formation on charts that indicates potential future price movement, such as head and shoulders, a reversal pattern indicating a potential change in trend. Not only that, you consider double top as well as bottom. Reversal pattern signaling potential trend changes. And we equally consider triangles, continuation patterns that can signal continuation or reversal of the current trend. We should not forget that. We should take consideration as an individual who wants to adopt the strategy of technical analysis. Number 8, candlestick patterns. Analyze formations of candlesticks. Example, doji, hammer, engulfing, to predict potential price movement based on historical pattern. And this particular strategy actually involves the analysis of candlesticks that will determine precisely whether to buy or sell, to hold, or to dump a given security. Please give me a thumbs up, a like, and don't forget to subscribe to this channel. Number 9, Fibonacci retracement levels. Use horizontal lines to identify potential supports and resistance level based on Fibonacci sequences. And lastly, number 10 is divergence. Compare price movements with technical indicators to identify potential reversals or continuations. Divergence occurs when the price makes a new high or a new low while the indicators do not. Technical analysis is used to make short-term trading decisions and can complement fundamental analysis by providing insights into market timing and as well as price behavior. As I earlier informed us, personally, I adopt and I utilize fundamental analysis. I'm not the trader, I'm a fundamental investor. And so I think I will go with fundamental analysis because actually it company fundamentals. The technicalities, that's a little bit of financial voodoo. Anyway, the choice is yours. Actually, you go with it based on your personal preference and your ability to do what? To be able to obtain the level of performance you want to obtain as an investor.